Joining us right now, our favorite economist, MacroMavens President Stephanie Pomboy is here. And Stephanie, it's good to see you.
Thank you so much for having me.
You were so right about the economy the last time you joined us. Everybody was all about, oh, things are great, things are great. And you said, look at the tax receipts, look at the income numbers. Things are really slow. And that's exactly what we saw with the GDP report in the quarter. What are you expecting now?
Well, thank you. I expect more of the same. I mean, honestly, this idea that we're going to have a spontaneous acceleration in growth has always kind of bemused me, because growth peaked in 2015 and it's been steadily slowing since. So every quarter they come out with, a 4% growth forecast, and I'm trying to figure out why it is that we're suddenly going to see this spontaneous acceleration. My feeling for the second quarter is we just continue in this trend until something comes in and changes the fundamentals, like some kind of tax reform or, a massive change in oil prices, et cetera, et cetera. It's hard to see what could possibly reverse the trend in growth from here.
Are you encouraged that at least the House is moving on this health care bill?
Definitely. I mean, I think that's very encouraging. We'd like to see this get done and then really get the tax reform on the table and passed, because we're really fighting against the clock now. The economy is slowing, and you're starting to see the credit cycle has turned. You're starting to see delinquency rates rise. You saw the reports from Capital One, Synchrony, Discover. Obviously, the subprime auto thing has been brewing for a while. CoreLogic reported last week that serious delinquency, the ones that were seriously delinquent on their mortgages, actually bottomed in 2015. And albeit from very low levels, has started to move higher. And they observed that, when the trend turns, it usually doesn't go up for a month and then reverse. When the credit cycle turns, it turns and continues to deteriorate. So we need to see some positive movement on the fiscal front to help arrest these forces before they become entrenched.
What about the jobs number today? I mean, 185,000 jobs is what people are expecting. Yeah. That's got to be better. It's got to be better than the month before, which was horrible, 98,000.
Yeah, it'll be interesting to see what they do in terms of a revision to last month, because that number did seem like, wow, where did that come from? And if they don't revise it up, that's going to be a very powerful message that, hey, maybe it's not just seasonal or an aberration. And I think, the 12-month run rate on jobs now is around 175,000. So I don't have a major beef with the number expected for today. But it'll be interesting to see, because we were running at 275,000 in 2015 when everything peaked. So the trend continues in jobs, as with consumer spending and real growth, to decelerate.
Yeah, Stephanie, what do you look for in this jobs report? Like, what are the key indicators that you really focus on? Well,
again, I'd look at the revision to last month, if there is any, and obviously wages. I mean, the wage number last month was also very disappointing. In real terms, average hourly earnings they're not increasing at all. And in real, we're at zero. Yeah. So we need to get some real take-home pay for people. Obviously, labor force participation is also critical. And one thing that's been going on for a while, and I think we talked about in prior discussions, is the labor force participation of people 65 and over is the highest since the 60s, because they can't afford to retire. And that's kind of creating a bottleneck.
So that may be more important, that you see the unemployment rate may tick up a little bit higher from 4.5 to 4.6, but if we can get the participation rate to move up a little bit, isn't that more important?
The unemployment rate is kind of irrelevant. It's what goes into it that really matters.
The calculation of it.
You could take everybody out of the labor force and get to 0% unemployment, and I don't think that would be cause for celebration.
So the participation rate, you're saying the 65 set?
Right, 65 and over
65 and
are
over.
Record participation, or the highest since the 60s, and the participation rate of 18 to 22-year-olds is the lowest since the 60s, because they're not having jobs freed up for them because all the would-be retirees have to stick around.
That is really an issue. You still see, even some of the younger millennials, too, they say, living at home, or not as many maybe even participating yet in the workplace. Generation Y, still, of course, younger, but living at home, not participating in the workforce, maybe staying in school longer or doing other things. So you're right. I do think that is a concern, because years ago, we started talking about, oh, there's going to be a shortage of talent and all the baby boomers are going to retire. And to your point, you're saying, no, they're not. Yeah. They're not retiring because they can't afford to, right?
Yeah. Well, I don't know why they're still sticking around the labor force if they didn't need to. I mean, why would you be having margaritas with the mariachi guys?
There are some people who work into their they work until they're ready to meet their maker.
And I think that's what they should do. We've never stop working because once you stop, it's
and then
really,
the mind goes.
It's very difficult. I think people
mentally able.
You know.
You got to stay in.
You got to get. What about oil? We've been talking about oil prices this morning. 5-month low on oil. What are the implications of this in terms of having on the broader market, in terms of the economy?
Well, I would say that oil is just one of many commodities that has dropped sharply in the last few months. The CRB peaked in, February, is down 10%. Dr. Copper is down 10% since February. So it all kind of dovetails with this slower economic growth story. As relates to oil, I think that's really interesting because I look at the spec positions every week, the commitment of traders, and the speculators came into this year record long oil. They were incredibly bullish. Prices were around 50. They were more bullish than they were when prices were at their peak in 2014. And as the rig count has gone up, inventories have been built, and the price has come down, they've stayed bullish. They've taken down from their record position, but they're still as bullish as they were at the peak in oil prices in 2015. So we got to shake those guys out, I think, and that process could be really painful for oil prices.
Tom Close has warned about that. He said when you hear people predict significantly higher oil prices, they're talking their book.
Well, also the marginal cost for domestic producers has collapsed. I mean, I remember looking at this in 2014, and the break-even was like $85, $90 a barrel. It's now $35. So they can afford to continue to ramp up production, and I think you're seeing that. The rig count's more than doubled in the last 6 months. I think, we got lower prices. I think the pain trade is lower before we see higher prices.
Before you go, Stephanie, do you buy into the idea that this administration can get to 3% growth as a result of these tax plans? A lot of people are questioning whether or not 3 and 4% growth is achievable in the next couple of years. What's your take?
Well, I come back to that issue about the credit cycle that I talked about earlier. I mean, once the fear gets into the system, it's very hard to get it out. So my little quip is we need to see fiscal stimulus take effect before credit quality infects the economy and the market psychology. It was like with TARP. Remember, we had that panic. There was so much credit risk concern out there, and you needed to implement some massive fiscal stimulus to try to get people to
stop panicking.
It sounds like you think it is achievable, but
we're really running against the clock.
We're running against the clock. The credit cycle has begun.
It's begun to turn, and if it starts to really deteriorate, then they're going to have a major problem, and they'll have to do even more aggressive stimulus to really have the kind of numbers that they want to put on the board.
Really interesting stuff.